Hey everyone, thanks for joining us on our quarterly market commentary here for spring 2026. I invited back Apollo Lopescu, who's a good friend of mine from Dimensional. Um, just really enjoy how he explains. He's quite intelligent, but he can explain stuff using simple pictures and using simple illustrations. So Apollo, welcome.
Great to see you, Matt. How are you?
I'm doing well. I'm doing well. It's been a pretty quiet quarter so far, right? Like no headlines, hardly anything going on. So I'm
Nothing
sure
going
you've
on.
been doing nothing, right?
Right. Nothing happening in the world.
Yeah, so when we reflect back on the quarter in review here, and of course, when we're talking to our clients, we're always trying to make sure that we're thinking through the lens of, okay, yeah, there's stuff that's actually going on in the markets, but it needs to fit into this bigger picture. So when you look at what's gone on in the last 3 months here, how should investors be reacting? There's all the tensions in the Middle East, there's
Right.
AI stuff. How should investors be reacting?
Yeah, and I think it's probably the best place to start is to kind of roll the tape a little bit back to the end of last year when the U.S. market had a very good year. It's like well above the long-term average, and there was a lot that happened last year. We had the shutdown, we had the tariffs, and yet the markets did plow ahead and did a very good year in 2025. And as we started this year, 2026, January was actually a positive month. The S&P 500 was up about roughly about 1.5% in January. And then February was kind of decent, like it wasn't good. I mean, we the market dropped by about 1%. But on balance, for the first 2 months of the year, there's not really that much that was going on. And what's fascinating is that when you look at the third month of the quarter, that was March, the S&P was down about 5%. And certainly that was, to some degree, and it was not ever easy to put one factor as the dominant one, but obviously the conflict in Iran and the Middle East probably had a big impact on the market, and the market was down about 5%. So when you combine these 3 months together, what you find is that for the first quarter of 2026, the S&P 500, which is a broad measure of the U.S. market, was down about 4.3%. And what's interesting is that to your point, there was so much that has happened over the past few months, and yet the market really hasn't tanked. And to get some perspective, if you go back to 2025 and you look at the first quarter of 2025, it was an identical result. We were down about 4.3% for the first quarter of 2025. And what's so interesting is that the tariff date, the big announcement that really tanked the markets, did not happen until early April. So it's not even included in the first quarter of 2025. So I wouldn't, read too much into how the markets did so far, because last year, even with the tariff date that came in the second quarter, what you saw is second quarter was positive, third quarter was positive. Fourth quarter was positive, leading to a nice result. So don't read too much into this first quarter and the fact that the market dropped. We did have a lot of uncertainty, and all things considered, it's not a terrible result. Now, what's also interesting is that when you look at this number, the negative 4.3, it's a reflection of the performance of 500 different stocks. And if you look at and you take a closer look, what you see is that for the first quarter, about half, a little more than half, 53% of stocks went down in value and 47 went up in value. So not every stock went down for the first quarter. And in fact, almost half of them went up. And the question is, well, what are some of the standouts? And to me, what's interesting is not concentrated into one industry or one sector.
Mhm.
If you look at the best performing stock, it turns out that for the first quarter is a company called SanDisk. And for all of you out there, photographers, if you pop a little, memory card into your camera, that's likely made by SanDisk. You remember the USB drives that you pop on the side of the computer? That's made by SanDisk, a lot of them. And that was the best performing stock. And he went up 175% for the first 3 months of 2026. Outstanding. You had a Dow. Dow Chemicals that was up about 80%. You had Moderna, the vaccine maker, up about 70 plus percent. And you had others like the certainly the energy companies like Occidental or Chevron, Exxon that went up over
Hmm.
30%. So we had a range of great performance, not all concentrated in one industry. And at the low end, like companies that didn't do very well, if you look at the bottom performers that lost more than 30% of their value, you had Estee Lauder, which is a cosmetics company. You had Ares, which is a private investment company. They invest in private equity, private credit, and so forth. You had Paramount, the company that ended up buying Warner Brothers, the studio. That was down over 30%. But also Robinhood. Robinhood was down quite a bit,
Hmm.
the trading platform. Workday, the one that we use for HR, and also DoorDash. So again, it's not easy to say, well, it was obvious that that company is going to do well or not. It was all over the place. And a really smart investor would have been diversified across all of these because it wasn't obvious at the beginning of the year which ones would do well. Now, to go from these 500 different results to a single number, investors not only pay attention to the performance of each stock, but there's another critical component, which is how big is that company? By big, we mean what is the value of the ownership? And ownership means like how many shares of ownership does a company have? How much is each share worth it? And the larger the company in terms of its value, the greater the emphasis on its performance. And that's why these companies that are nicknamed the Magnificent Seven are not only
Hmm.
important because they're so dominant and they have to do with tech and so forth, but they're some of the largest in the US market. And that's NVIDIA, that's Microsoft, Apple, Facebook, Amazon, Google, and Tesla. And what's remarkable is the market was down about 4.3%. And if you take these seven companies aside, what you see is that for the first quarter, they were down quite a lot more, 11.3% down.
Hmm.
So they underperformed the market substantially for the first 3 months. And they left a hole in the S&P. So if you look at the S&P 500 minus these seven, let's call it the S&P 493, what's remarkable is that the rest of the market was actually quite resilient. It was down only about 0.7%. So what's fascinating here, Matt, is that when you're looking at the market, you see sort of a tale of two different types of companies. You had these magnificent seven, these large dominant, really tanking for the first 3 months. The rest of the
Hmm.
market was pretty flat. And what's even more interesting is that these seven companies, they are not as impacted by oil. You know, Nvidia doesn't have trucks where they use oil. Apple, Microsoft, none of these are companies that are so dependent on the Middle East, and yet they tanked substantially. And the reason they had such a big impact, without them, it was negative 0.7. When you add these seven stocks, it went down to negative 4.3, is because among the seven of them, the seven companies amount to about 32% of the value of the entire S&P, which means that about a third of the performance of the S&P is driven by these seven stocks. And the same exact seven stocks are also part of a different metric called NASDAQ, but instead of 32% in NASDAQ, they amount to about 51%, more than half, very, very concentrated. And because of that, NASDAQ did not go up by about 4%, but rather about 6% down. So more because of this concentration in the MAX 7. On the other end of the spectrum, you can look at the same Magnificent Seven in the context of a global allocation, because there are certainly a lot of companies that you can buy outside of the US, a lot of stocks outside of the US. And when you integrate these seven companies, the Max 7 is part of a global portfolio. What you see is that that global portfolio has only about 18%, so a lot less in these Magnificent Seven. And because of that, what's quite interesting is that on a global level, it was pretty flat. Like if you look at a global equity fund, it was roughly flat, not much that happened to that global equity. So I think it's super interesting to explore this idea that when you look at stocks as a whole around the world, they were not overly concentrated in these Max 7. The results were actually pretty flat, not much that you can talk about. And if you know, it's quite different than what people perceive by looking at the news. Now, one quick other thing. part of a plan. When an advisor sits down with a client and develop a plan, quite often it's possible that stocks are not the only component. Stocks are about ownership, but there's another form of investing that has to do with lending to corporations and governments, and those are called bonds. And they might actually be a substantial portion of some people's portfolios. If you're
Hmm.
close to retirement, you don't have a lot of other assets or pensions, it's quite possible that a decent amount of your assets might be in bonds, not even attached to the market. And when you look at bonds, what's remarkable is that they held up well. Bonds, these contracts that go up to about 1 year, these short-term bonds are actually up about 1% for the first 3 months. So, long story short, a comprehensive allocation that might have some U.S. stocks, international, emerging, some bonds. What's incredible is that if you look at the end of the quarter, it's pretty flat. Really didn't move much, which is contrary to what most people would think with all the stuff that happened in the world. So don't think that what's on the news it's reflective of what's in your allocation because it's quite likely different if you have a plan that particularly calls for international, emerging, and bonds.
That's great. A couple headlines that we've seen. I mean, obviously we touched on the conflict in Iran. Another headline that we've seen a lot here this quarter is, and really, sorry, this quarter over the last year and a half has been around AI,
Right.
capital expenditures around AI. My personal observation has felt like over the last 6 months, it feels like the conversation has kind of switched substantially, where maybe 6 months ago it was, hey, all these companies are spending all this money on capital expenditures on AI, but is it actually going to generate anything to justify the expense? And then now, at the beginning of the year, you saw so many of these software companies have, substantial declines because they were going, are they going to be able to justify their service that they're providing as a software provider because of the advanced capabilities of coding within these AI things? Yes, can you speak a little bit to that, Paul?
Absolutely. So there are multiple layers to your question, and the first one has to do with the level of investments that companies are making in AI. And just to give you an idea, if you look at four companies, Microsoft, Amazon, Facebook, and Google, four large companies are part of the Mag 7. You look at these four companies alone, and in 2026, they have committed to spending money on AI, these capital expenditure that you talked about that are quite large. In fact, if you make these investments proportional to the size of the US economy today, it turns out that in the history of the country, there's only one other time when we made a greater investment than these four companies are making today as percentage of the economic output. And it's not the railroads. Railroads, first of all, took a lot longer to build, but it's surpassing that. And the only other bigger investment that we made in the history of the United States is the Louisiana Purchase in 1803.
Wow.
That was the only other bigger investment than these four companies are making in AI this year. So certainly very big numbers. And the reason they're making this, to your point, is that there's an expectation that when this technology really starts coming online and becoming prevalent and improving, it will replace a lot of the systems that we have today. We talked about Workday, which is a company that does HR and so forth. Like that's how I put in my personal time off. I go on Workday. Well, it turns out that a lot of the software companies today are feeling a bit challenged because these new AI systems can reproduce their technology very, very quickly. And that begs the question, if you're a company, why would you want to pay an expensive subscription to a software when you can have AI recreate that and be almost as robust or close enough, but save you a lot of money? So that's the idea that some of these software companies are going down in value because investors are not exactly sure if people will continue to pay for their services if they can recreate that with AI. So
Mhm.
that's sort of the good news about AI is that there is an expectation they will replace, and at that point, it will get big, more and more use. Now, the flip side of that, which is so interesting, is that as investors have formed these expectations, the prices of some of these companies associated with AI have also been kind of going up to reflect great expectations. And let's just put a quick example. Let's take a company that is in the Max 7, not these four, but another company that's in the Max 7 that has staked its future on AI. In
Hmm.
fact, their core business was to make cars, and certainly we're talking about Tesla, and they're going to discontinue two of their models that actually were the higher margin. They were where they made most of their money, Model S and Model X. They was not going to make any more because they want to focus on AI. So what is interesting to see that this firm is kind of an example of like, oh, it's all in about AI. So if you look at the beginning of the year, and you look at the price per share for Tesla, it was roughly about $450 per share. And what's interesting is that if you buy a share of Tesla, you partake in the ownership of that business, pretty much like Elon Musk. Not as much as Elon Musk, but you are entitled to the ownership equivalent of earnings compared based on how much you own of that company. So what's fascinating is that you can partake into the earnings and the profits of Tesla pretty much like Elon Musk. Again, not as much as him. So the question is, okay, so I bought a piece of this business. What were the earnings associated with this business when I paid $450? And it turns out at the time, the earnings associated with that one share of ownership were roughly about $1.50. Those are the earnings. So if you reframe that, you kind of think about this way. Okay, so I just spent $450, and at the current rate of earnings, Tesla comes and puts a buck 50 per year into my piggy bank. So again, at these current rate of earnings, at this earnings level that is today, how many years would it take for me to make up that initial investment of $450 and actually start being ahead? And it's not complicated math. It's about 300 years that you'd have to wait at the current rate of earnings before Tesla actually becomes a good investment for you. And you can compare that with another car company that has nothing to do with AI. You can take Toyota, still make hybrids and regular gas engines. And at the time when Tesla was 450, Toyota was less than half of that. It was $250 a share, $15 a share. And the earnings associated with one share of ownership were not $1.50, but roughly about $20, which made it about a 10 years payback. So the point that I'm making is that as an investor, you can ask, well, why would people buy Tesla? It's so expensive relative to Toyota. You can get $20 in earnings currently. The idea is that what companies are and what investors are doing, they are pricing in today great expectations of future profits. They're saying they don't make money right now. Yeah, they make about 50, but just you wait when they turn on the money spigot, boy, left and right, hand over fist, they're going to make money, and you're going to be happy that he paid 450 at some point. So a lot of these AI companies have really increased prices relative to current earnings in the expectation of future profits, and which they might materialize, they might not, and that's something that it's not clear at all today whether or not they materialize or not. But it is something that we've seen in the past. And I think the last time we saw this was during the internet era. And there was another revolutionary technology, Matt. And at the time, people kind of had the same question. Well, there is a great expectation of these companies. Will they ever make money? Or would it be a bubble? And a lot of people still kind of go back and say, well, there was a bubble. So is there a bubble today? Well, if you go back to the internet days, and it's similar today, there was no entity called the internet. There was no monolithic investment called the internet, but rather what you had were a bunch of companies. And the way to think about these companies is they are like horses in a race. And as the race gets going and you have this technology, is it obvious who the winners will be? And if I took on a time machine back to the mid 90s and I said, well, there's a company that sells toys for kids on the internet, there's a company that sells books for reading, and then one company that sells pet supplies. And I asked you, well, which one of these will obviously become the future of internet retail? Was it obvious at all that Amazon, the bookseller, would become that? Not at all. So to me, what is important to know is that today, pretty much like in other times, you have to accept that in order to own Amazon or pets.com, you also have to own eToys and pets and pets.com. And you know, so that's the idea is that if you hyper focus on the fact, oh, pets.com, the pop socket, the hand socket, whatever, you know, went out of business, and everybody makes fun of that. Well, you miss the fact that yes, they went out of business, but Amazon became Amazon. That the same period launched Google, which became a money printing machine and changed the world. You know, Netflix changed entertainment. All these companies that became some of the largest, most successful in human history came from that period.
Hmm.
And don't miss the forest from the trees. I mean, if you hyper focus on the companies that went out of business, you miss the fact that the ones that survived more than made up for everybody else. And those great expectations did plan out. You look at Google today and you look at Microsoft and how successful Facebook and Amazon and the money that they make is tremendous. But back in those days, again, there was the expectation of great profits. And that's kind of what I feel we are today with AI. There is no monolithic investment called AI, not an entity called AI, but a bunch of horses in the race. And at this moment, it's not clear which one of these will survive. But we do know for sure, the same as the internet, some companies are going to blow through a lot of money, create nothing, go out of business. In fact, a lot of the founders, like venture funds that were funding Google and Facebook and Amazon, they will tell you, like everybody was, they're pretty transparent. We're going to invest, let's say, in 10 companies, knowing that maybe six of them are going to go out of business, produce
Hmm.
nothing, burn through our cash and disappear. Two or three maybe chug along, get acquired, nothing to brag about, and then one or two are the moonshots. They're going to more than make up for everybody else. And that is the private equity logic that is now permeating into the AI, although it has been like this as part of the stock market for the long run. If you look at a 20-year cycle in the US stock market, we typically see about 3,000 companies at the beginning of a 20-year cycle. And at the end of this 20-year cycle, what's remarkable is that about 60% of them disappear. Only 40% or so of companies survive. 60% just don't make it 20 years later. And out of the ones
Wow.
that survive, it's only a handful, about 18%, that actually outperform the market. They're the high flyers that drive these nice market results. And certainly everybody wants to know, well, I just want to put money in the 18%. Well, good luck with that. Everybody's looked at that. And if you just pick a number of companies, you're a lot more likely to pick four out of the five that don't do well rather than one out of five. So to me, the big story here with AI is like we have seen something like this in the past. Whether it's looking at the market as a whole, look at the internet, don't be disappointed or scared that, oh, these companies might blow through money and create nothing. It's possible. And their prices right now reflect great expectations. They might materialize or not. I would just be cautious to say I should be invested or not invested. I think you ought to be putting money in every single possible meaningful company in the world. That's what we suggest. That's what we talked about, this global allocation. And at that point, you're not overly exposed to AI. You still participate in the Max 7, but at the same time, you also have a Toyota and other companies that might be a great deal at the moment relative to the more expensive AI. So have AI as part of your portfolio. Don't be disappointed if some companies disappear, and stay disciplined because that's the key. Not trying to jump out and just feel like, oh, this is the end of the world. Just be patient, and the market is rewarding investors over the long run.
Paul, can I have you maybe just with a couple minutes here? I know we're probably a little over time on this one, but can you speak just a little to obviously the conflict in Iran? I'm kind of bouncing around here, but you see the price of oil increasing over time. People see it when they're at the pump. Can you speak to how that affects valuations of companies, inflation, all that kind of stuff, and what should investors be thinking as they see what's going on in the headlines and the conflict in Iran?
Yeah, I mean, I think that the first place I would quickly go on to is just that there's a real human element to this, and there's a lot of suffering that is going on right now, and it's kind of hard to watch sometimes, and kind of hard to think that we have U.S. soldiers and Marines and all that in the Middle East, and they're in harm's way. You have civilian population that was trying to overthrow the regime that now might be hurt themselves by what's going on there. So there's a lot of suffering, and that tends to trigger emotions, and those emotions are real. And I shouldn't be ashamed because I have a hard time kind of seeing some of this. What I also found is over the years is that sophisticated investors acknowledge these emotions, and at the same time, they disentangle them from investment decisions, and they're very pragmatic. So, with respect to this conflict, what the true question that the market is asking, and I know it sounds cold-hearted, but it's the right one, is that how is this conflict impacting the opportunity for a company to make money? Because if you buy ownership into a business and all of a sudden they won't be able to make as much money because of the conflict, well, the value of the company shouldn't be as high. I don't want to overpay, so the price should drop. If they're going to make more money, it should go up. So the question again is, how will this conflict impact different companies? And the bombing of Tehran, the first time happened on a Saturday. Monday, when the market opened, a U.S. airline with a lot of flights in the Middle East dropped about 3-4% in value, which is exactly what I would expect. At the same time, a U.S. defense contractor went up about 3-4% in value. Same conflict, very, very different results. By and large, the market on that Monday was flat, did not move. And that was not because people were not paying attention, but rather it was a very clean signal that based on everything we knew, it's unpleasant to watch the images. But when it comes to Nvidia and Facebook and Coca-Cola, McDonald's, and Google, we don't see them as having the conflict having such a big impact on their ability to generate the flows of profits and earnings and cash flows to investors. So that's why the market didn't move. Now, by later in that week, what became apparent is something unknown at the beginning of the week, which is what is the Iranian strategy, which became apparent by the end of the week, which is, well, they're going to shut down the little narrow passage of way that everybody knows about. It's a geography expert on the Strait of Hormuz. And when that emerged, there was a realization that because about a fifth of the world oil will not be able to flow the way it used to, that's going to create a huge problem because oil now is going to become a scarce commodity. So when that happened, the market adjusted to say, wait a second, maybe it is the case that it's not just that people are going to pay more at the pump, which is hard for a lot of folks to kind of spend the additional $50 or whatever they spend per month on gas. But what it means is that they might not go out to eat, and that's going to impact the restaurants. And you also found that if it's more expensive to put gas in a truck, well, moving fruit and vegetables around is going to maybe lead to higher prices at the supermarket. So the markets accounted for all of this, and ultimately, that's why you saw that in March the market dropped by about 5%, which is not pleasant. Again, it's not a devastating number. It's not like something that it's horrific, and we've seen this in the past, roughly in the same ballpark. So again, it's a very unpleasant emotionally, but again, the market's looking at the opportunities of companies. And at least at the moment, they don't signal that, oh, this whole thing going to be horrific. The signal is that we do expect this is going to clean up based on what we know now. It might take some time, maybe a few months, for the oil to flow back, but the expectation is that this will be resolved. And if that's the case, then that's great. If it's not, then whatever new information comes in will be priced. But I would again distinguish between the emotional impact of the images versus the practical application to a company. And the last thing I'll tell you is that we have seen this before in many. It's different this time with the Iran and everything. It's absolutely different. What's similar is this idea that people tend to be resilient, and because of that, companies tend to be resilient, which makes the market resilient. And what I mean by the resilient, when they are faced with a challenge, they're going to try to figure out how do we move beyond that challenge? How do we continue to operate? And a lot of times at the back end, it might come out stronger. And a good example of this is if you go back to 73, 74, when we had a huge oil crisis, that's when OPEC decided not to send any oil to the US. What you had was a situation where not that the gas prices were high, but there was no gas to be had. People were standing in that line, and imagine that you were towards the back of the line and you're thinking, oh my gosh, the world's coming to an end. We're not producing any oil in the US, and this is horrific. And what's interesting about today is that after that oil crisis in 73, 74, as a country, we had a policy of building energy independence. And 50 years later, we're a net exporter of gas, we're a net exporter of oil. And today we're a lot more insulated than the rest of the world because of the challenge that we had back in the 70s. When the pandemic happened, once again, very challenging for companies to operate. Well, they figured it out. And eventually they got back on track and the world kept going on. So oil is going to do what it's going to do. The good news is that as opposed to the 70s, when the government capped the price of oil, there's like it went from 40 cents and the highest point was 50 cents. You couldn't go about 50 cents a gallon back in the 70s. Today, it's a free market. We're not capping that. And that means that it's expensive, but at least you have it. Back then, it was not as expensive, but there was no gas. But again, any challenge might lead to a strengthening in a company or the country as a whole.
No, that's great. I love that you conclude on that investing in equities is investing in human ingenuity. It's a core principle that we talk about with our clients. And yeah, I think when you frame stuff, I mean, financial media rarely has the best interests of our clients at heart, and really appreciate you helping our clients to help tune out the noise.
It's great fun talking to you. Thanks for having
Awesome.
us.
Awesome. Thanks, Apollo.
Bye bye.